Buy, sell, or hold the idea of value beating growth over the next 5 years.
Sell.
Buy, sell, or hold bonds right now.
Depending on the duration.
Long-term bonds right now at current rates.
Uh, I would say hold to buy.
Buy, sell, or hold the S&P overall. Are you optimistic about the market?
Yes, buy. I'm always optimistic about the market long term.
What is smart beta? Just how smart is smart beta? And should you be using smart beta in your own investing? Joining me to answer this question is my friend Carlos Diez, founder of MarketGrader, a smart beta or alternative indexing firm that's been around for more than 20 years and whose portfolios have a track record of outperforming their benchmarks. Carlos, thanks for joining me.
Thanks for having me, James.
And I should disclose, BBAE, I'm acting as an impartial interviewer in this context, but we're also very happy because we just inked a partnership with MarketGrader. And we do have BBA's MarketGrader Smart Beta portfolios, 3 of them available now or shortly for our own customers. So we think they're awesome. Thank you for putting those together, first of all.
Absolutely.
All right, so let me unpack this. So first there were bonds, then there were stocks, and then there's a stock market. And the stock market kind of like generally goes up because it generally represents the sum total of at least the publicly traded businesses of a country. And so people said, I want to buy the stock market. I want to buy it as an index. And those indexes were made with market cap in mind. And that's like mostly pretty good most of the time. But then someone had the idea, well, we could weight these indexes or create them using factors other than market cap. Can you take me from here or take the viewer from here and explain how this connects to smart beta and what you do?
Yeah, so you have to think first about why that happened, why people started thinking about weighing indexes or building indexes differently than the traditional indexes. So before that, though, I would say that probably one of the biggest inventions in finance, or one of the inventions that have benefited the most people, the most, has been the index fund. The index fund started in the early 70s with about the $6 million original investment, the first one. It's grown to over $25 trillion in assets. So what does that mean? It means it's benefited a ton of people. And the simple premise of an index fund is you should own the market as it's regularly configured. So the market is basically a market cap weighted collection, right, of all the companies that you could buy, be it in the United States or globally, right? So first and foremost, we are fans of indexes. We are indexers at heart.
And the index fund, by the way, was hated at the beginning. It was a hated idea, if I recall.
It was because it went against a lot of vested interest in finance, right? It was basically saying you don't need active managers, you don't need expensive active managers that often underperform, where you can just, in a very cost-effective way, own the entire market, right? So it was very much going against the grain of what the evolution of finance had been. So you fast forward to, say, the late 90s, and you have this massive run-up in internet, telecommunication stocks, in the second half of the 1990s. So those stocks got really large within the indexes, and they got very concentrated, meaning as these stocks became larger and larger, they started to account for 3, 4, 5% of say the S&P a piece, which means that when you add 3, 4, 5 of them, all of a sudden you have 20%, 25% of your portfolio, if you're indexing, tied in just a handful of names, which happen to be very closely related to each other, similar businesses, internet, telecommunications, and so forth, which means you have a massive concentration risk, but through really no fault of your own. You've been told to index, so you're indexing, but the index forces you, as the index grows and these companies grow, because it's market cap weighted, it forces you indirectly to buy more of those more expensive stocks, which means that leaves less money to allocate to the less expensive stocks, which are becoming all of a sudden value stocks. So what happens in 2000, 2001, you have a massive correction, and then investors lost a significant amount of capital principal.
Because just to jump in, so you think you're diversified, but you're not quite as diversified as you may expect. And B, you're kind of like joining the bubble, or you're piling on to the trend, because by index, by market cap weighting an index, you naturally like favor the ones that are growing the most, and
Yeah.
so you have no choice but to participate in that bubble.
And when you have one of those big drawdowns, so that's correct. And when you have one of those drawdowns, you're hit with a double whammy, basically. Number one, you have a significant loss in your portfolio value, right? And then, assuming that you stay invested and maybe keep allocating money to your portfolio like you should, it takes you a long time to kind of get back to even. So you're forfeiting very valuable years of compounding growth, which is the most powerful force in the market, right? So if going back to the 2000 example, the Nasdaq lost close to 50% from its peak in 2000. It took the Nasdaq 15 years to get back to where it was back then. So if you're an investor in the Nasdaq, those 15 years are 15 years that you're not getting back of not participating in the market upside. Now, having said that, going back to the original premise of the index fund, the market, if you go back in history, if you look at the US alone, the US market, and I'm talking about 100 years plus history, the US market has given you 7.5% in real returns. That's after inflation every year. Is it every year 7.5% religiously? No, some years it'll take back 20%, or another year it'll give you 30%, but historically it's been 7.5%. So we've always said the number one goal, or the first goal an investor should have, is take what the market gives you. So don't go against your own self-interest. So that's kind of the premise of the index fund and traditional indexes, because of the issues that I described with overconcentration in the largest stocks and what have you. We have this right now. We have 25% or so of the S&P in like five or six stocks. Then you want to kind of think differently about how you select the companies and how you weigh those companies, and that's what smart beta is. So smart beta is not about I'm going to pick these 4 or 5 home runs or potential home runs, and because I identified the next whatever technology, I'm going to select a broad basket of stocks, and I'm going to either select them differently or weight them differently, or both. And that's what MarketGrader does, and that's what we try to achieve with those indexes.
Got it. And if you're looking on the internet, you'll find some people like smart beta as a term, some people don't, but it could be anything. I mean, it's a broad term. You could weight by anything literally except market cap, or I guess price. Nobody really weights by price except Dow Jones. But they tend to be fundamental. Like you might have a dividend weighted, or you could rate by sales growth. They tend to be our return on equity, things like tend to be fundamental factors. So, but Carlos, now take me back to 1999, the late 90s, let's say. What's the genesis of MarketGrader? What got your interest peaked in this, and what made you decide to start MarketGrader and focus on this alternative indexing?
So it was a bit of that dynamic that I described. I can't say that I foresaw what would happen, but I remember I was in college in the late 90s, and buddies of mine were investing in internet stocks. We're college students, so we don't have a lot of money. So when I say investing, putting $500, $1,000 here or there in internet stocks. I remember vividly friends of mine would say, "Oh, I bought the xyz.com today," and I said, "Okay, what do they do?" I'm not sure. And why'd you buy them? Well, they're up 30% in the last month or so. So that didn't fit with me, and it was pretty clear that a lot of them did not know either what the companies did, if they were making any money. So I figured, that there's got to be a better way. These companies are public companies; they're reporting, their financials, so you can tell if they have a lot of debt or not, if they have good sales or not, cash flow, all these things. So, but at the same time, you should not expect the average investor to spend 3 hours, assuming that they know how to do it, to take an income statement, a balance sheet, and do an analysis and say, okay, this is a company that I want to own. So I thought there's an opportunity to build a system that does that analysis, that analyzes the quality of the companies, irrespective of size, business model, and so forth. And so that was the genesis of MarketGrader. Let's build something that analyzes these companies fundamentally, and issues a rating, straightforward buy, hold, or sell rating that says this is a good stock for you to buy, or this is not a good stock for you to buy. And that was the beginning of MarketGrader. So we started the firm in late 1999. It took us about almost 3 years to put the whole thing together, the whole system, the data, and then we launched the first MarketGrader, or the version of MarketGrader, in 2003, where we rated initially every stock in the U.S. and Canada, pretty much. And then we said at the same time, nobody knows who we are, and we need to kind of put this to the test. So we need to build some portfolios using our methodology, right? So we built a small family of indexes where we said, number one, we're going to select the companies based on that rating. And then number two, we're going to weigh the constituents equally, because we just learned the lesson of 1999, 2000. And that was the birth of the MarketGrader indexes back in 2003.
I want to ask in more detail about that in a moment, about your strategies. But first, Carlos, if I were to go start a smart beta company and I wanted to do it in the worst possible way, how would I do it? In other words, what are some common mistakes or pitfalls of smart beta investing?
Well, you're talking to someone that's made a lot of mistakes over the years. So we've learned we've learned by doing, right? So there was no smart beta to speak of back then, right? This was a theory, and I'm not saying that we were the only ones that did that. There's other companies that have done so very successfully, meaning they kind of identified the same issues that I'm describing, and they said, we need to build something better. We need to stick with indexes, but we need to either select or weigh the constituents differently. So there was, I would say, there was a lot of testing, a lot of trying by doing, like I described, for us and others. And you kind of start seeing how things behave, right? And you can back this all you want, and you can theorize about how things might work if we do more value or more growth, or if we focus more on small caps or whatever that is. But then it's the market that actually shows you how things really work in live, right? When there's a crisis, when there's a sell-off, when there's a mortgage crisis in 2007, 08, how does the market behave when you do that? So you have to stay humble, and you have to kind of take the lesson that the market gives you, but at the same time you need to stay grounded on the principles that you're trying to follow, right? For us, it's identify good quality companies, own them for the long run, provided that the fundamentals support that, and then just do it through in an index structure, meaning that's transparent, replicable, relatively inexpensive, and so forth.
And you've got 20 years now of history with your indexes, which is pretty important. If someone's just new to this conversation, the idea of out-of-sample testing or just testing in real time is very important. It's easy to look back and cherry pick. Oh, if I'd bought stocks beginning with the letter T on Tuesday, I would have made a lot of money in the past 3 years, right? Well, there are probably thousands, hundreds of thousands of statistical artifacts like that make you think this is going to actually work, but it doesn't work going forward. So something where somebody says, here's a strategy, now let's see how it rolls going forward, like that's a lot more valuable data than kind of a look back or cherry picking bias, which is probably common, I guess, among some of the low tier operators.
Absolutely. And so, not to say that we don't backtest our indexes, our portfolios, we do. A big difference between the backtests we do and maybe what others do is that all these backtests are based on live ratings that we've had running for a long time. Like I described before, we've been rating companies for a long time. North America since early 2000s. We added global coverage to our platform in like 2010 or so. So almost a decade and a half, like covering global markets. So, and we publish these ratings every single day. So it's very easy for you to go back and see, how did we rate any particular company, 5, 10, 15 years ago. So those are the building blocks from which we build our indexes. And yes, this has been, and many of the indexes themselves have been run in, live in real time. We have, a number of the ones that I described that date back to the early 2000s. They're still running. We have a partnership with Barron's, where we created a broad portfolio for them, or indexed with them, I would say, called the Barron's 400. That's been live since beginning of 2007. And that has a market cap weighted version and an equally weighted version. So yeah, these have been running live for a long time.
Got it. And so you mentioned individual stocks. You can go into Market Grader and get a rating, from good to bad, and you can make your own strategy if you want to. You can go long, short, probably like an absolute return. But let me, again, for someone new looking at smart beta, it's more of a statistical thing, meaning like it's probably the best way to use Market Grader or really any smart beta approach would not to be to go in and say, I'm going to buy two stocks that are the best in Carlos's database. You could do that, but it's probably better to buy a broad basket because you're exploiting properties that have been proven generally in academia over many years to work well. They're not necessarily going to work on just one or two stocks. You need a big group, or they're not going to work on for 3 months. You need to hold a bunch of stocks for a while, at least in my experience, to get the benefit of smart beta. Would you agree? So it's more of a cornerstone strategy than kind of an icing on the cake strategy for your portfolio.
Absolutely. So think about it this way. You can have in it. Put simply, you have in an investment. You have, let's say, two ends of the spectrum. One being a pure index, the market cap weighted index. So if you really want to passively own the U.S. market, you own something like the Russell 3000, which is basically it accounts for about 96-97% of the aggregate weight of the market. So you're gonna do what the market does, and you're gonna take what the market gives you, right? It's not even the S&P doesn't do that. The S&P it's close because it's market cap weighted, largest companies, but it's still you're making a bet on the larger names. So anyway, on one end of the spectrum we have that like pure passive, right? On the other end of the spectrum you have pure active. Pure active is a traditional fund manager, a mutual fund where there's a team that is selecting stocks, whether it be all across the U.S. or U.S. small caps or technology or global whatever. And then it's very challenging for those managers to maintain a superior performance over the long run. Research has shown this. The average manager in the last 20 years has underperformed the market, right? So those are kind of two ends of the spectrum, and there's benefits to both actually. Smart beta sits a little bit in the middle of that. So it takes all the attributes about indexing that we described before, but it also applies some of the attributes of active investing. So it's not to say that Carlos or someone in my team or someone's like in the back like selecting stocks. No, it means that we apply specific metrics to select stocks, to identify and select stocks, right? In a systematic way that is replicable. So it's not, oh, today I like this stock, but tomorrow I don't like it. And then we are applying within the portfolio construction and management process also processes that are more akin to what an active manager does. A good example is regular rebalance. Whereas a lot of the indexes don't really do that. The indexes just kind of follow what the market's doing. We're saying, well, companies vary over time, prices go up and down. So a company that you might like today might do really well, and then a year from now might be too expensive. So you might want to take profits in that company and use that to deploy elsewhere and buy something else that looks attractive, right? Again, not a subjective call being made by myself or any one person or group of persons, but a system saying we're identifying this is getting expensive and there's more value here. Or we're identifying or we're seeing that this company's margins seem to be eroding, or the cash flow is not what it used to be. So because there's so many companies to pick from, the system is always kind of focused on selecting the best one. So our system is we look at 24 individual indicators for every company we analyze. And there's 6 growth indicators, 6 value, 6 profitability, and 6 cash flow indicators. So 24 individually graded, right? In a perfect scenario, a company that gets an A+ in each one of these would get a perfect score of 100. We translate those 24 indicators into a final numerical score, right? The opposite of that is a company that gets an F in all the indicators would get a 0, right? So we're running this process that's looking at thousands of data points every single day and basically rating every stock in the world according to this. And basically that we use that to select, in the case of most of our indexes, twice a year, the best stocks, be it the best large cap stocks, the best stocks in the US overall. And so it's a very consistent approach that is always kind of looking for pockets of value. Always focus on identifying quality companies.
So it comes down to these 24 indicators, which seems like a much more robust number than a lot of the smart beta strategies, or at least ETFs that you might see out there that might just do, one or two or three or four different variables. How sacred are these 24? How long have you been using them? Why did you choose them? And would you be open to adding or subtracting any at some point? Like, how do you ever reevaluate?
So the overall architecture of the system has been in place since the beginning. So it's always been those four categories, and why those four? So growth and value are what we call the GARP component of the analysis. So if you were to assign a label to MarketGrader or to MarketGrader's methodology, it would be GARP plus quality. So GARP is growth at a reasonable price. So we are definitely looking for companies with growth, and growth is
versus like a pure deep value. If somebody's wondering what's growth, you could have a company that's cheap and very slow growing or maybe declining business. That's a value investment versus a growth at least shows some movement in sales, some movement forward.
Exactly. And if you look at like, and he has said it himself, like Warren Buffett, when he started very early on, he was pure like value investor, right? Based on like Ben Graham's traditional like approach to value, the intrinsic value of a company. Can you buy it or own it for less than that? But over time, he discovered that you could actually marry that with companies that are actually growing and doing well, and that in itself is different than just pure value investing. You could be looking at a company that seems very cheap today, and maybe they're cheap for a reason. So maybe they should be cheap because their business model is poor, their business is eroding, they're losing market share to the competition, whatever that is. You don't want to own that stock just because it's cheap. So the growth part is very important. You want to, and growth is not growth at any price, right? Not growth just top line growth, but sacrificing margin, sacrificing profitability because they're spending a lot to build the factory, what have you. So we're looking at growth across all these, from top to bottom line, revenue, operating income, net income, EPS, and so forth. But then value is not viewed in a vacuum. So we're not saying anything with a P above or below this is good or bad. We're saying, what are those metrics, the relative to cash flow, to sales, to earnings, relative to how the company's doing, right? So that part, that GARP part is super important. We're trying to identify growth companies that you can buy at a reasonable price. And then the bottom two quadrants, so to speak, or the two quality segments are profitability and cash flow. You want to identify companies that are well in their business, making money, have good cash flow, that seem to be good capital allocators. So to your specific question, some of the indicators within those categories have changed over the years, not because all of a sudden we woke up one day and said, return equity no longer matters, or whatever, but because over time data has improved, right? We started in the late 90s, and so the quality of the data, the accessibility of the data, the specific items that companies report that are available to us, it's publicly available information, has gotten better and better over time. So we have refined the system, or helped the system evolve based on that, specifically when it comes to addressing differences in the business models of companies across sectors, right? If you're looking at a bank, the way a bank makes money is very different from how a technology company makes money, right?
And debt is basically inventory for a bank. Totally different than for most any other company.
Totally different, yes. Or the way you look at within the energy space, the way you look at, say, exploration companies, which have typically high capital expenditures versus, say, an MLP, which is really just a pass-through entity that is sought for distribution, right? For
MLPs are typically pipelines, shipping oil or natural gas or liquid natural, things like that between states generally, yeah.
Right, so at the end, you want to identify who's making money, who's doing well, whether it's an oil company, a bank, a technology company, how well are they doing at what they do, and how do you measure that? So we're trying to get to the essence of that company, and so some of the indicators vary. But again, within the same framework that I described before of growth, value, profitability, and cash flow.
Got it, got it. And if someone's watching this again, saying, okay, why all this fuss? Why don't I just go buy, an S&P index fund? I would say that's fine, right? If you want to, nothing wrong with that. That's always a good baseline. But that can get frothy, as you mentioned earlier at the top of the interview, and it's not always as diversified as you think. And the idea of having these 24 factors as opposed to just market cap is that these are things, a lot of them have academic evidence in their favor. Many studies in some cases support, if you buy stocks with low PE, you buy stocks with high ROE, over time you'll probably do well. But there can be periods where the market is not so much into low PE, in the late 90s as a growth market, or the past, really 12 years. When you were talking about your friends in college buying all those stocks, that reminds me also of what we've seen in the past 12 years. Rock bottom rates we've had, which favor biotechs, which favor, these tech companies that have earnings way into the future, right? And so that can pull the market away from long-term averages, long-term trends. And the idea of having these factors say, hey, wait a minute, let's get back to what's been the long-term reality of the market. Let's anchor on that rather than float off with price. And a lot of people have said smart beta didn't do as well over the past 12 years, Carlos, as maybe it should have because the market was so frothy. But you got people like Rob Arnott from Research Affiliates, really an early smart beta pioneer from the beginning, saying now could be an especially good time for smart beta because the market might be coming back to its senses. It's had a party. 2022 we had a crash, not crash, but at least a major decline. It's back up a little bit this year, but in general, we have a market that's favoring more kind of reality-based cash flows than just some hot tech stock. Do you agree with that?
Yeah, so first of all, I would say that not all smart beta, so to speak, has done poorly the last 12 years or so. Some of the more value-focused or value-oriented methodologies have, because value has simply underperformed growth the last 12 years or so, for the reasons you described. When money was free, it was for people that have access to capital, it was easy to make money, right? You could always almost make no mistakes, right? And you were rewarded for earnings that you projected very far into the future, right? Like it's okay, like they're gonna make money, 10 years from now. When money is at 5%, the cost of capital, so to speak, then capital allocation decisions have a significant bearing on your.
Yeah, suddenly it matters. Yeah,
they matter a lot. So because we've had this focus on growth all these years, and also quality, we've actually done pretty well the last 12 years. There's times when some of our indexes don't necessarily keep up with, say, the Nasdaq 100 or the S&P when everything that matters is, the latest, technology, like, 5, 6, 7 technology stocks. But overall, we've done well those years. There's an important aspect also to think about when thinking about smart beta, the way we look at it, it's the kind of the behavioral aspect of it within the stock market, right? So if you go back to the original index fund or funds, a lot of the premise on which it was based, or some of the academic research on which it was based, said that the market was efficient, perfectly efficient, almost, right? So meaning you can't beat the market, so you might as well just own the whole market and just partake. So that is partly true, but the market is not fully efficient because the market is made up of millions of people making decisions every single day, and we're humans and we make decisions based on feelings, right? So when everyone's partying and everything's going great, everyone feels like partaking in that party, right? So it's very difficult to say when interest rates are at zero and technology is doing great, and some of the stocks you alluded to are doing great. It's very hard to say, own some energy stocks and maybe own some like industrial stocks and some material stocks. People are like, it's kind of boring. Like, I want to own, the sexy stuff. So if you're able to kind of trade against that kind of like common wisdom, which is oftentimes not that wise, then you're able to identify pockets of value and over time do better. So a big part of the smart beta equation for us is kind of helping you as an investor, as a person, not make those mistakes that we always tend to make, right? So if you have this system that is saying, you're going to buy this when others are not, or you're going to sell this when others are buying it, then over time you tend to do better because it's all based on the numbers.
Yeah, if you look at going back to the academic literature, we are our own worst enemies as investors. It's almost always a cognitive bias, a behavioral mistake that derails people. Trading too soon, trading too frequently. That's why the systems do so well, is they take away that human judgment. Carlos, let me ask you. You mentioned that Barron's 400 ETF. In general, on your website, you mentioned that you have a lot of different indexes, and I think almost all of them have outperformed their benchmarks by generally like several percentage points on average, which is phenomenal, and especially in this recent market. I mean, I know it's a little more growthy, and that's what's been helping you too. But that's great. But if you look on like Yahoo Finance, the Barron's 400 ETF has underperformed, at least the S&P 500. Why is that?
The Barron 400 that has an ETF tracking it, which is BFOR, is the equally weighted version of that. So that was an index that where the selection is based on our methodology that I described before, where we purposely wanted to equally weight the constituents so that it doesn't matter if you're a $1 trillion company or a $1 billion company, you have the same weight, right? That makes it look more like a mid-cap index,
Yep.
and it also makes it look more like a value index, because you can have the Apples and the Microsofts and the Nvidias of the world, but if you have 4 of those, for example, which would be also in the S&P, those would also only account for, say, 4 of those would account for 1% of the weight of the index. 4 of those in the S&P, depending on which ones you pick, are going to account for 50%. So it hasn't kept up with a lot of that kind of froth, if you will. Say if you go back 10 years, in the last 3 years, it actually has outperformed it. Because the last 3 years, if you look at from the last quarter of 2021 and throughout 2022, where there was this kind of perceived rotation out of growth, that pure growth, and into more value that Robert Knott has been talking about, then some of these methodologies have done much better. So in the last 3 years, it's done better. Prior to that, it has lagged, not by a lot, but by some. Now, if you take its sibling, there's a market cap weighted version of the Barron 400, which is where you want to see how good the methodology has done, right? Because it's the same stocks, but you're saying, okay, we're now going to compare apples to apples. We're going to say, rather than the 500 largest, which the S&P selects, roughly, we're going to pick the 400 best, and we're going to market cap weight them and see how they've done. Since that index has been live, same time as the equal weighted version that has the ETF, that index has outperformed the S&P by about 160 basis points per year, and that's live performance. So that's 1.5% or so per year, which over time compounds to a significant advantage, right? Again, that's the market cap weighted version versus the equally weighted version.
Got it. One last major question, and we'll move on. You mentioned earlier adjusting by industry or talking about MLPs, for example. I know in Yahoo Finance, and this is as a former hedge fund analyst, as a former research director, I'm always nervous when I see people looking at statistical blocks of data, because I think, there's so many accounting adjustments that I used to go in and make. How do you adjust? Do you adjust for like REITs, for example, which tend to use funds from operations, which adds back depreciation instead of net income, or master limited partnerships, which tend to use distributable cash flow? What kind of individual adjustments do you make on a company level?
More than a company level, industry or sector level. As I alluded to before, companies in financial services are some where we pay particular attention to some areas of either the balance sheet or the income statement, mostly the balance sheet. So if you're looking at a bank, net interest margin is an important part of profitability. Return on assets, solvency-related indicators are very important. If you look at MLPs, distributions are, like you mentioned, very important. So we look at their ongoing distributions relative to their cash flow. Are they sustainable? How do they fit with the overall capital structure of the company? For REITs, we also make adjustments along the lines of what you described. So yeah, we make those adjustments across mostly sectors and industries.
Got it. Got it. Cool. Makes sense. Makes sense. That I feel better knowing that. Let's do very quick lightning round. Don't think too much about these questions. Just give a little bit of insight into who Carlos Diez is as a person. I'll keep it mostly investing focused. Buy, sell, or hold the idea of value beating growth over the next 5 years.
Buy. I would agree.
Buy, sell, or hold cryptocurrency.
Sell.
Buy, sell, or hold bonds right now.
Depending on the duration.
Long-term bonds right now at current rates.
I would say hold to buy.
Got it. Got it. All right. Buy, sell, or hold the S&P overall. Are you optimistic about the market?
Yes, buy. I'm always optimistic about the market long term. I have no idea what's going to happen in the next 6 or 12 months.
Neither do I. Neither do I. Long walks or long talks?
Why not both?
Good answer. Favorite movie?
Oof, tough. It's probably close between, say, Pulp Fiction, Kill Bill, and The Godfather.
Huh. Pulp Fiction, they're kind of violent though. So some of those, but I have not seen Kill Bill, actually. But
Yeah, I'm a big Tarantino fan. They are violent, but I think the storytelling is just incredible. The writing is amazing.
yeah, yeah. I remember watching Pulp Fiction when it was kind of like mid '90s, I guess, when it came out, mid to late '90s, right? It was fresh. It was a fresh way of presenting a movie, and I thought that was pretty cool.
Yeah, it was great. It was
Excellent. So Carlos, if someone watching this, I mean, if you're obviously a BBAE customer, you can look in our app. You can find this information already. We got these portfolios ready for you. We hope you go check them out. And if you're not, we still love you. We still thank you for watching. And if you're not, if you want to get more information about Carlos, you want more Market Grader, I'm guessing Carlos, MarketGrader.com is the place they can go to learn more.
Absolutely. MarketGrader.com, best place to go.
Carlos Diez, founder of MarketGrader. Thank you so much for sharing your time, your insights with us today. And thanks, as always, to you guys for watching at home.
Thank you, James.